So many people have such a bad taste in their mouth for insurance or anything that's attached to the word insurance.
Yeah.
Oftentimes rightfully so, right?
So, some things have earned their black eyes, you know?
Well, so much of insurance in the U.S. has become less insurance and more cost share programs.
Mm-hmm.
It's so hard in finance to not have FOMO in finance.
Oh, yeah.
It absolutely destroys finances to have FOMO. At the end of the day, your portfolio is only going to get compensated for accepting risk. You have to own risk. That is the only way to do it, right? If not, you will sit in cash or cash equivalents like T-bills or money markets, and you will get eaten alive by inflation.
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks Podcast. I'm your host, Brandon Ducharme, and today I'm joined by a friend of mine here in St. George, Mitch Hancock. And Mitch focuses his practice in the financial space here on what so many people, sometimes including myself, is considered to be probably one of the most boring segments of the whole industry. So with that lovely introduction,
That's right.
I want to give everyone the fair warning that, look, what we're going to talk about today can feel so unapplicable, and it can feel so foreign. It can feel so unneeded. And the reality is no one ever thinks about this particular thing until it's way too late. It's way in your face.
Mm-hmm.
And at that point, you're oftentimes between a rock and a hard place. And so that is long-term care. And the opportunity set around funding long-term care, whether you choose to self-fund it or use an insurance contract to access maybe a higher amount of leverage, and what those trade-offs look like, right? For people that have been listening along for a while, and Mitch, I don't know if you even saw this episode, but I did an episode with my dad on long-term care, maybe a year ago or so.
No, I haven't seen that one.
And he talked about, his experience with long-term care, which was caring for my grandparents as they age. My dad's lived on the same farm his whole life, lived next to my grandparents. And so he was the sibling that was there. Right. And so people talk about, my kids will take care of me. Yeah. Yeah. But listen, he did, but it was not like, it was still a full-time job almost for him to manage the care and coordinate, because it was the care needed was so intense. Yeah. In this case, it was a lot to just coordinate, right? Like the help, showing up at the house to take care of them. So it wasn't my dad going and feeding them, but it was like dealing with it and then paying the bills and making sure the accounts were taken care of and the taxes were done and the people were paid and it's no joke. It's no joke on time commitment. And so if that that is a kid taking help. That is a kid still helping out in a major way, right? Oh, yeah. So on top of all that, somebody still had to help through the very uncomfortable things that require you to have long-term care. I mean,
the bathing, the dressing, all of that stuff, right?
Yeah. Let's cover it really quick. The 6 activities of daily living. Tell us what they are. What qualifies somebody to need long-term care, or like what constitutes a long-term care event?
Yeah, for sure. So I can always only remember about 5 of the 6. So we'll see how I do at remembering all 6 off the top of my head.
On the spot.
So you've got bathing, toileting, transferring, assistance with eating, and then what else am I missing there? Transferring, basically getting in and out of bed, and then there's another one. I've got should have the list right here.
It's it's stuff like getting dressed, eating. Right. Yeah, going to the bathroom, showering, bathing,
and so what kind of constitutes, when does someone need care, or when are they like officially in a long-term care like claim situation? It's when they need assistance with 2 of those 6 activities. So if a medical professional is like, yeah, you need help with at least 2 of those 6, that's where it kicks in.
You need help getting from bed to the recliner or whatever, you know what I mean? And you also are incapable of cooking for yourself. Yeah. Right. Like, so you need help eating. Yeah. Not necessarily somebody to spoon feed you the applesauce quite yet, but like at a certain point, it's impractical to be like, I'm going to make a stew for myself.
Mm-hmm.
If you can't hold the knife to chop and you can't do those things, right? There's not an expectation that people live on microwave mashed potatoes.
Yeah.
I mean, heck, at a certain point, even if your diet's applesauce, you got to be able to open the jar.
Totally.
Right.
Yeah. And this is one of those things where it's difficult for people to imagine themselves in that circumstance. When you're healthy, you're bulletproof. You're like, oh, I'm sure that's never going to happen to me. Yeah. But the reality is that 7 out of 10 retirees at some point in retirement are going to have some sort of a long-term care need, whether that's, you were just telling me, I'd love to hear a little bit more about your family situation. But in my own family, I had a grandpa who had a very short long-term care need to where he only needed long-term care for about six weeks. Mm-hmm. So not super long. But then on the other end of the spectrum, I had a grandma, not his wife, but my other grandma, who was in a long-term care facility for almost 7 years. Yeah. And so it's this kind of moving target of how in the world do you plan for this, and what kind of impact that can have on someone's portfolio, especially when costs are, on the low end, 5, 6, 7,000 a month. On the higher end, you're flirting with 10, 11, 12, 13, or, sounds like you had a even more significant situation with your family where it was just way more than that.
Well, it's my understanding on that is it really depends on the depth of care that you need, right? Absolutely. So, for example, my grandpa had pretty significant. He broke his hip and he came out of surgery and had dementia. Mm. Basically, dementia set on as he came out of, and they had warned him actually that it was a potential side effect of going under anesthesia at his age in his 80s. Mm. And, but he had fallen and broken his hip and, so it was kind of living in a wheelchair or whatever, or risk dementia. He made his choice. Yeah. And so the result was his body wasn't really quite ready to give up, but his mind was pretty much gone, and in a pretty significant way, pretty quick. And so, he ended up, that lasted from, 2015 to 2019. And,
stretch.
Yeah, it was pretty good stretch, but it required 24/7 in-home help. Luckily they were very blessed people that, had diligently saved. One of my grandpa's kind of core, tenets about himself was self-reliance. So, he had prepared for that kind of thing and they had the resources to do it, but it was, very expensive, even relative to what people look at when they say like, what's the national average for, care at home? Well, what I can tell you is that national average number probably looks a little bit closer to after my grandpa had passed and my grandma was still doing okay. Mm-hmm. And we cut back to, well, I say my dad was helping manage the situation, and him and my grandma had decided that they could cut to part-time care for her. So somebody would come by the house in the morning, help make sure she was out of bed, get going. Mm-hmm. They'd kind of leave a couple hours in the afternoon. Somebody would come back in the early evening, help make sure that she kind of got in bed okay and had gotten some dinner and this kind of stuff. And then they'd go home, overnight, right? Yeah. That looks more like in my observation, that looks more like the national average when they say care at home. Yeah. If you talk 24/7 in-home care because there's an advanced case with a lot of need, the cost in my observation looks a lot more like the memory care unit. Yeah. High-end facility cost, right? Because you're essentially taking a high-end $15,000
a month. Yeah. Those
if you're lucky, it's probably, and because you got to take that skill, that constant monitoring, you got to now, instead of having it at a facility where there's skill, you got to bring it to your house. Yeah. It's just economics. Mm-hmm. And, no one wants to think about them being in that situation, but my grandma lasted, a couple of months, and then it was maybe about after 6 months or so, they had to go back to increasing the care quite drastically, pretty quick. And she then passed in 2022. Mm-hmm. So you have a couple more years of significant expense, right? Yeah. And people underplan for it. Now,
absolutely.
That's the cost side of it. And the interesting thing about the long-term care conversation that I found is you're going to have the cost of it doesn't matter what you think of long-term care, right? Like you don't get to pick if you're disabled or not, right? Like correct. You just get to pick if you want to have insurance or not, right? Like long-term care is no different. Whereas I guess really almost any insurance is that way, but it just seems like you can really disconnect the long-term care piece from the insurance product piece that's oftentimes being offered around this, because people sometimes do have the ability to like self-insure in a more meaningful way, right? Like where something like auto insurance it's so cheap.
Homeowners insurance.
Yeah. Homeowners insurance is like, like it's so cheap relative to like, okay, I can pay $100 a month on homeowners insurance or whatever it is. And it's fine. But if my house burns down, which I know happens, my house will be fine, right? Like I don't care to look at my account and say, hey, if my house burns down, I'm not worried about it. I can just cash out some extra 401k funds and build a new house, right? Like that people don't want to go through that, so they carry the insurance. Yeah. On long-term care, it really does become a conversation of how likely do you think this thing is going to be to happen, right? Like, so understanding the peril is a little bit different. And then the next part is like, what's your capacity to self-insure that? And do you want to self-insure it? Yeah. And you don't have to it's not A or B, right? It can be, how much do you want to,
how much risk do you want to take on yourself versus how much do you want to, shift over to the insurance company, right? Like those are the fundamentals of insurance. We were talking a little bit about licensing before we clicked record, right? And one of probably the only thing that I really feel like was super helpful with the exams that, you take to get your insurance license is just understanding the core tenet of insurance is how do we transfer risk away from the insured to the insurance company? Yeah. And so when it comes to the long-term care kind of planning conversation, if people are going about it saying, hey, I'm going to fully self-fund this. I'm just going to, I've got a healthy nest egg. I've got, some assets saved up. I'm going to just cover it. I had this conversation with some advisors the other day where they're like, hey, we've got some high net worth clients. And I don't know that like it's really that big of a deal if they just self-insure. And what I shared with them is saying like, well, if you could have an extra couple $100,000 in retirement that would be spent in more meaningful ways, of that if by doing some planning, you could pass on another 100,000, 200, 300,000, 500,000, whatever it is to, your beneficiaries or causes that you care about, would that be meaningful to you? And so it becomes an efficiency play as well, from like, not just how do I protect myself from catastrophic risk, but also how do I be, fiscally prudent with my funds and be efficient for a risk that is likely to happen.
That's an interesting thing because so many people think about insurance as like this baseline component of a financial plan, right? Like when you start talking the Dave Ramsey baby steps, right? It's like get the term life insurance, get, like before you even start investing, right? It's like do the insurance thing first because it protects the baselines. What's interesting about long-term care, in my observation, is it's really a little bit more complex of a tool that I think comes out of the toolbox in a more favorable way in cases that are a little bit more advanced, right? Like in people's that have a little bit more net worth or a little bit more established, it makes a bit more sense. And the reason why is we all sort of have this really terrible, but long-term care program, but no one wants to use it. Right. And it's called Medicaid.
Yes. Medicaid. That's
And you know what I mean? So it's just like, hey, we all have a retirement, but is Social Security going to cut it? You know what I mean? Not, right. Like, is that what you want to base your life on? But the reality is like to get on Medicaid, you end up having to spend on all of your assets, right?
Yeah. To basically poverty levels, right?
Yes.
Like
you got to be out of money, you got to be out. So if you don't have a lot and you don't have cash flow in your 40s, 50s, early 60s to divert to a long-term care plan, right? And get that funded, your main goal is like to stop working. You're less concerned about what happens at the end. You know what I mean? You're kind of planning on dying at zero anyways. Yeah. Then Medicaid all of a sudden becomes like, it's not a glorious solution, but at least if you're rolling the dice saying like, maybe I have a long-term care event, maybe I don't. What I don't want to do is not be able to ever retire because I want to plan for the long-term care event. Right.
For sure.
And so it's a little bit flipped backwards. Right. So I think the flaw was that the guys you were talking to thought, well, like, we've got these high net worth clients. But they don't need long-term care because they have assets to pay for it themselves. And what they're missing is the operational efficiency you can have on a plan through the access of targeted leverage, right? So it adds, like in portfolio speak, it adds some convexity. Yeah. Now convexity doesn't always pay off, but it's mathematically a good idea, right? Like, because when it does, it pays off big.
But But one thing that I want to say there, so you started talking about Medicaid, right? And that's a great kind of social safety net that's there. But one of the things that I want to emphasize, because sometimes people think, well, I can get creative and I can shift assets around. There's look back periods. There's things that
5-year look back period.
The government is they want to make sure that they get theirs. If they're going to put money out in this program, that they can look back and claw back assets and put liens against an estate and all of those kinds of things. So it's a great social safety net for those people who maybe don't have a significant amount of assets. But it's probably not the rosy plan, the rosy retirement that people thought it would be.
One of the things we don't talk a lot about on the podcast is, we talk about the Ducharme side of the family and my grandpa on my dad's side. We don't talk as much about my mom's side of the family. And, the reality is, on that side of the family, my mom's mom, my Nana, she passed away living in a Medicaid facility, and so it was interesting as a kid to see the dichotomy, this bifurcation of finance, right? Where you have, one set of grandparents that are super focused on self-reliance, being wise stewards of resources. And on my other side, it was more of the, live in the present mentality.
Sure.
And she didn't make it. She's ran on Medicaid. And it was a really sad, what I can tell you is it's a really sad situation.
Yeah.
Like it is not.
You let go of control in a lot of ways in which you wish that you could have control, right?
Well, and it's not a facility that you would most people would not look at a Medicaid facility and be like, that looks like it's for me.
That's what I want my parents or grandparents in.
Yeah. Or myself, you know what I mean? It's like, it is not designed to be, the luxurious stay at the end. It's not the most comfortable. It's not known for having particularly good or high quality care. And it's really sad to see somebody go through that. Right. So, evaluate your life choices accordingly.
Yeah.
I want to get into the efficiency side of this.
Cool.
Because so many people have such a bad taste in their mouth for insurance or anything that's attached to the word insurance.
Yeah.
And oftentimes rightfully so,
yeah,
right?
Some,
like
some things have earned their black eyes,
so much of insurance in the US has become less insurance and more cost share programs, and people really hate that because the cost gets really high. They say, well, I never had the car accidents and I'm just sinking all this money and I'm a safe driver, Well, the long-term care is a little bit different because no one's forced to buy it. It's very targeted. It's well thought out. Because of that, the underwriting, who gets underwritten is different. It has underwriting. And it can be a little bit targeted here. But long-term care insurance does have a black eye from the past.
Yeah.
And if all you say is long-term care insurance, man, that black eye is fresh for a lot of people because those policies, man, I have seen them destroy.
Well, you've probably seen the costs on
finances.
Them double. You've probably seen situations like I have, to where I've reviewed an old policy where the insurance company, it's kind of like blackmail of like, hey, you either pay this increased premium or you take this like settlement amount for like you've paid in, whatever the percentage is.
Yeah.
You're going to get this that you can take as cash, but otherwise your money just went down the drain.
I have seen people in cases where they go from paying, so in their 70s as they're like really, you know what I mean? So they sign up in their 60s and they're paying $100 a month or something, right? And then they get in their 70s and it's 150 and it's 200 and it's creeping up, but okay. And then all of a sudden they get into being like 85 and it's like, hey, it's $3,000.
Yeah.
You know what I mean? And it's like, hold on, that's like more money than I have. I can't, that's all my money every month. Right. It's like, and it's like right when you're like, oh, I could have a long-term care event any day now.
When I need it the most. Yeah.
But because the way that those contracts were structured, more like, oh man, the IUL industry just put a bad taste in my mouth for any time I say the way a contract's structured.
Yeah.
Anyways, but the way the policies were designed, right? It was more like an auto policy, right? Like, hey, you, excuse me, you pay in every month, and if something happens, you get the benefit, right? If you just cancel it, then it's gone.
Yeah.
And as one gets older, I think it's probably opposite with auto insurance, but with maybe like life insurance, say the older you get, the more likely you are to have this issue. And so the costs would just go up if it's just renewing every year, like an auto policy. Yeah. And that's how long-term care insurance worked. And it was just so devastating for so many people. Because by the time, people have just been living longer and doing better. And so by the time they get around to like being like, hey, it's really any day now, it's like the cost is extremely high.
Yeah.
And you kind of look at it and you go, okay, so I'm out of money in 4 years if I don't cancel, right? But if I do cancel and have a long-term care event in the next 24 months, then I'm also out of money really quick. And you're just kind of between a rock and a hard place. And it,
100%.
but that's what the industry had really pushed people towards for the long-term care piece traditionally until, what was it? Maybe like
the past decade or so.
Yeah. 10 years ago or so, they kind of came out with, some people call it like asset-based or linked benefit. What do you kind of refer to it as?
I generally, refer to it as asset-based long-term care planning. Those may be a linked benefit plan. They may not be a linked benefit plan. Kind of depends on which route that we go. But asset-based long-term care planning really solves for some of those weak points or those black eyes that traditional long-term care insurance earned, right? Of whether people paid into it for a long time and ended up not needing care, and then it was just a use it or lose it kind of a plan. So I like to use the term asset-based long-term care because what we're doing is we're capitalizing an asset. That asset is either going to pay out and help pay for long-term care in the 7 out of 10 chance that you're going to need long-term care, or in the 3 out of 10 chance that you don't. That money doesn't go away. It can actually, basically your basis can pass along to beneficiaries, plus a little bit of a step up in basis, depending on the plan, right? And so there's a death benefit. So this asset doesn't go away. It's just we've capitalized an asset. How is it going to be used? For care, or is it going to be passed along to beneficiaries? Yeah. And that's where I see a lot of, there's great leverage that we can talk about around that, but that's kind of the simple concept is how do we capitalize this asset?
Yeah. Yeah. Talk into the operating leverage side of this, because normally I'm not a fan of insurance companies, right? If we talk about trusting the insurance company to give you the return, like in an IUL product or some of these other, the index annuities, I'm incredibly skeptical because how they build the functionality of that. I can recreate in this market. Well, it's like I can recreate in the market with an options trade and not have to pay the insurance company their spread. They're spread basically, right? Like, and so I have a hard time understanding why that product's even needed. But with long-term care, the way that I understand it is like the dynamic really completely shifts.
Yeah, 100%. So the example that I like to use is just to kind of use nice round numbers is that if someone were to take $100,000, generally speaking, they could capitalize this long-term care asset, and that's going to create a benefit pool of $200,000 to $300,000. So we put $100,000 in, and that turns into $200,000 to $300,000. That's great leverage, right? Like if on the trades that you do, you do incredible work on the equity side of things. So if you guys are not paying close attention to what Brandon says, like if you could predictably double or triple people's money,
it takes time. It takes a lot of time.
Yeah, but like immediately, right? If you could do that in the equities world, that would just be this crazy, money printing thing. And so that's literally what's happening inside an insurance contract for the specific purpose of long-term care funding, because it's this targeted risk that we're solving for. And actuarially, they've made it all work behind the scenes to where the insurance company is not going to be coming back and asking for more premium later because we've capitalized this asset that has kind of a defined benefit pool.
You're allowing the insurance company to go work the assets. And if you know anything about Warren Buffett and the way that he invests, right? Like the free float matters to insurance companies and their profitability on the backside. But you're also now saying like, hey, so I've got access to this pool of, in your example, $200,000 or $300,000, right? And everyone that signed up has access to this pool of $200,000 or $300,000. But the secret is that only 7 out of 10 people are going to use it, and of the 7 or 10 people that use it, they're not going to use all of it.
Correct.
Right. And so all of a sudden that's how the insurance company can come back and say, hey, regardless of what the markets do, we can still, employ the traditional actuarial practices of insurance to offer you this benefit, because not everyone's forced to buy it. And so we don't have all the bad actors in the space,
totally,
committing, fraud or even just bad behavior because they don't mind right? Like, so it's kind of the old thing, right? Like if everyone was forced to buy a disability policy, way more people would be racing motocross and, snowboarding, right? And doing all kinds of like, sketchy, scary activities because they'd say, well, I don't care if I get disabled. They made me buy a policy, right?
It's marketplace insurance, right? Everybody has it. Yeah.
Yeah. Right. Yeah. Hey, I go to the doctor because everyone has to buy health insurance.
Yeah.
You have this health share. No one is going like, I'm going to get long-term care insurance and make sure I need somebody to come to my house and help me bathe.
Yeah.
Right. Like that's regardless of how crazy you get, and you don't want that. Right. And so you still have people buying an insurance for a prudent reason and then trying to mitigate in their life that they don't want to have to use it. Right. Like they don't want to fall back on that. It doesn't become, there's really no like financial incentive to need long-term care. And so the actuarial practices kind of allow for this. Help me understand more when you said like, well, okay, so if we capitalize this asset, which is, fancy speak to maybe mean like earmark it, right? For something specific.
Yes.
And so you've turned it over to the insurance company. What happens if so you put 100,000 in and, 15 years later, hey, you're getting a little older. So you've got this policy well thought out, but hey, what knocks your lights out is a car accident, not, old age and dementia. And so all of a sudden you made it to the end and you didn't need long-term care.
Yeah.
What happens,
Good question there. So in the event, 3 out of 10 chance that you don't need long-term care, you have a death benefit that's associated with that, meaning that you want to pass that on to your beneficiaries, whether that's, family or an organization that you care about, those kinds of things. So that's kind of the one way that you can make sure that this asset passes on somewhere else. But on the other side, let's say that someone says, you know what, I'm going to kind of take the risk and I want to use this asset, depending on if it's an annuity-based plan or if it's a life insurance-based plan. This is either cash value life insurance. So there are cash values that could be assessed in a situation or accessed if someone wanted to access it. Or in the annuity case, there are, we could flip the switch and turn that into an income annuity, depending on the product. And so there's a lot of just kind of options that otherwise people would have had on traditional long-term care insurance.
So there's some complexity in potentially planning and the fine tuning of the details, but the gist of it, if I'm understanding you right, is basically, hey, if you don't use it, you didn't lose it.
Correct.
Your beneficiaries, however you decide to, kind of structure that or name or whatever, get the money back basically, right? Yeah. So you're not paying, you are legally paying the money to the insurance company and they're definitely giving you an IOU. But in theory, right, like if we're trying to explain this in a more easy way, you're loaning the money to the insurance company in effect, right? That, with a 0% interest rate, like it's not going to make you money, but excuse me, at least the cost now of having this type of product isn't that it's sinking money into the insurance companies. And if you don't use it, you've just, given up so much capital for the years. Your cost is, in my opinion, like now kind of more the opportunity cost of, hey, maybe I could have taken that 100,000 and over 20 years, I could have doubled it into, 400,000, right? Sure. So there is a cost, but it's a lot easier pill to swallow because you're saying, hey, I could have 400,000, but also if I end up needing the long-term care, then my bill for long-term care could easily be 800,000.
Exactly.
So I'm now, you know what I mean? So now I went up 400,000, but now I'm down 400,000
because they kept the risk.
Because you kept the risk, right? But instead you're going to burn 100,000 of capital on the, on the policy. It's going to provide $300,000-$400,000 of benefit eventually. And so should you need it, you're fine. And you still have your other 400,000, right? So you're kind of positive 400,000 still. Yeah. And if you end up not needing it, now you've got 500,000 instead of 800,000 or whatever, right? It's like, so there is a cost to it, and it will be, if you don't end up needing any long-term care, it will be a net drag on your net worth, right? Like, but 7 out of 10 chances.
And to me, that's what's interesting is that you can even get insurance for this, right? Because once we're over that 50% likelihood, we're starting to get into the territory of adverse selection, right? And so it's really cool that insurance carriers have come up with a solution that still works, given how likely that risk is of the 7 out of 10 chance. That
I'm almost certain that the actuarial math on this has to be that of the 7 out of 10, a fair amount of people don't use the full benefit, right? Like they're not.
100%. Otherwise, the math wouldn't math.
It
right?
wouldn't work.
And so the big question becomes, we don't know who is going to need, whether it's like my grandpa, the 6-week amount of care.
Yeah.
And even in that scenario, that's tens of thousands of dollars, right? To pay for that very short term stay, or my grandma who was in a facility for 7 years. But kind of some of the averages, the average event lasts about 26 months to 44 months. So we're talking kind of 2 to 3 years on average for people. And what does that translate to cost wise in today's dollars? That's about $150,000 to $450,000 per person.
Yeah.
And so that's kind of the range. That's kind of the swing that we want to be kind of planning for.
Yeah.
And depending on the area, if you're in California, it's going to be more expensive than if you're, in Missouri, right? That I'm just guessing. I don't think I've done any long-term care plans in Missouri, but I'm assuming, lower cost of living, lower cost of care, those kinds of things. But that's kind of the amount, the exposure that we need to look at is that 150 to 450 range per individual.
Yeah. Well, I think what a lot of people miss and it's hard to have this conversation from like your side of the table normally when you're helping people put these kind of plans together. And so many financial advisors, I think, miss the boat on looking at the planning holistically, right? So I am always trying to look at things through the lens of one big giant portfolio, right? So regardless of whether you have, stocks in your Roth IRA, or you got stocks in your normal IRA or your brokerage account, where do you got bonds, you got CDs at the bank, cash in a checking or savings account, you got a whole life policy, you got whatever, right? It's like, and so you start thinking about insurance in terms of what it really is, and you almost take some of that. Sometimes we use it in portfolio speak. Like if you want to buy, put options on the market, you'd say like, oh, I'm buying some portfolio insurance.
Yeah.
Right. Well, like disability insurance is like a put option, right? On your income, right? You want to guarantee the income still coming in. Well, if you're doing that, now your behaviors can be different other places. You can potentially take more risks. And so with the long-term care piece, right, it's this theory of like, hey, okay, so you're coming into retirement, you have long-term care, you've got an asset-based long-term care plan, you've got a big bucket of money set aside for the long-term care event that even if it's not as big as you would like, maybe it at least gives you maybe 2 years or 3 years of runway to recalibrate other things, right? In case it comes at the worst time when like a market's crashing or whatever, right? Well, the idea being, if you say, hey, this thing is taken care of because of the insurance, what you want to do now is say, I need to offset. And so this is where the efficiency comes in. Hey, rather than being so conservative because I need to make sure that I can always liquidate out and start paying for bills and, blah, 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 blah. I need to seek more risk premium other places with the rest of my dollars. And so you want to increase that's how you use it as like an introduction of efficiency into an overall portfolio. The idea being, hey, so now, I've taken 100,000 off of $1 million portfolio. It's a 10% allocation, right? But you solve for this big bucket of money that would otherwise have to come off of the remaining of the $1 million, right?
Yeah. And so in that scenario, there's a $100,000 cost, but let's pretend that there was the actual cost of long-term care was $300,000, right?
Right.
And so it cost you 10% to solve for this risk versus if they would have self-insured, it would have cost them 30% on that $1 million portfolio.
Right. So now you have 20% remaining. You can say, what can I go do with this capital, right?
Yep. That's the efficiency.
And that's where your efficiency comes in, right? So like that's capital efficiency. That's using leverage for capital efficiency rather than using leverage for, just being riskier.
Yeah.
And that capital efficiency can introduce a significant increase in a lot of cases to the likelihood of making it to the end of your financial plan and not being broke. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com. And we look forward to talking to you.
You kicked this off by saying like, this is one of the most boring pieces. I totally understand. Thank heavens there's insurance nerds like me that find it interesting. But I heard this analogy once where, like a lot of times we want to do when it comes to finances, the sexy, the fast thing, hey, how do we, make a lot of money really fast, right? Yeah. And I had this friend who compared it to, all right, if I were to give you the keys to like a Lamborghini and you had this like straightaway road that you could just take that Lamborghini and go nuts, you'd probably be kind of excited, like, hey, that's cool, that's sexy, that's exciting. But if I said, oh, actually, that road is going to be iced over. You being in the Lamborghini in that icy road, suddenly the risk that you could have taken, the sexiness of that probably goes down a little bit because you're like, oh man, I didn't think about ice. Whereas maybe taking a little bit more of a boring vehicle of, if I had my trusty, truck 4x4, that might be a better way to kind of navigate that path given the risk of the icy road, right? Yeah. And so sometimes the flashy things aren't always maybe the most the most efficient way to handle the risk. Well, is kind of the analogy that I like to use is how do we take those risks off the table so that we can be free to do all of the cool stuff that you can do.
I think so much of this conversation hinges around the fact that people have really a lot of recency bias, right? And so younger investors are just completely forgetting that post 2008, you've had one of the most exceptional bull runs in the market, in both the stock and the bond market, right? Like in history. And hey, if anything ever went down a little bit, like, man, they'd pass some stimulus bills, they'd stimulate it up, they'd print some money and you're back off to the races, right? Like it was nothing, right? People that were like going into retirement, like in the late 90s, and they had 50% plus drawdowns in their portfolios, right? 2000 and 2008. Before it even got back to really, you barely probably nicked a high in 2007, and then you had another sell-off. Completely ruined your life.
Well, that's the lost decade, right? Is that what it's referred to as?
Yeah, and if you inflation adjusted, it actually went from 2000 to 2017. So nearly 2 decades in purchasing power terms, right? And so all of a sudden diversification is actually quite sexy in my opinion, but I'm also a nerd, so take that for what it's worth. Yeah. But in this recency bias, it's just so easy to say, well, like, look, S&P does look at 15% a year, I calculated this out. Oh man, this would be like the worst idea ever. It's like, well, yeah, if the S&P does 15% a year, then sure. Yeah. Like by all means. Yeah. But the problem is, if you look at where we're at in the economic cycle, Mitch, it's like CAPE ratio over 40, right? Like Howard Marks has talked about this. JP Morgan talks about it. Every time valuations has been this high in history, your 10-year forward-looking return is basically zero, So like you're planning on 15 and it's statistically, it's going to be zero. Yeah. Like all of a sudden something that gives you some kind of leverage that's not tied to the stock market and isn't even tied to like, well, the market has to go up to get this index crediting and all this other nuanced stuff. All of a sudden, like that becomes really interesting so that you can go out and seek and manage your capital maybe differently and add a diversifier to your portfolio when you view your portfolio as your total net worth statement, not, your account somewhere.
Totally. Yeah. Yeah, no doubt. What do you see when you kind of take the risk off the table for, whether it's long-term care or other risks like that? What does that do for a portfolio from your perspective? Like, what does that allow you to do if you kind of have solved for like, I know this isn't going to be an issue, this isn't going to be an issue. What does that allow you to do for your clients if those are kind of solved?
It allows you to seek more risk premium. At the end of the day, your portfolio is only going to get compensated for accepting risk, right? You have to own risk. That is the only way to do it, right? If not, you will sit in cash or cash equivalents like T-bills or money markets, and you will get eaten alive by inflation, right? It is not designed to give you a real return in terms of purchasing power. And so look, the deal with risk is it doesn't have to be risk of going to zero, right? Like a lot of times we think of risk as this binary, right? Like, hey, it has to work out all the way or it has to go to zero.
I'm putting it on black or I'm putting it on red.
Yeah. Right. And let's spin the wheel and see what happens. Right. Like that's not risk. You just have to remember, like, look, everyone's in different situations. So you got to own risk that somebody's going to can't own. And you get paid for that, right? So like not everyone can take the risk of stocks going down 20 or 30%, and so that affords you the opportunity to own the companies, saying, I don't really care about the stock price. I care about, the underlying fundamentals. Now, the markets in the US, in my opinion, are basically entirely broken. So that's like a really bad example of impracticality, but in a theoretical framework, that's how it should work, right? Hey, somebody else can't, they need funding for a business. And so you're going to accept the risk of not getting paid back in order to buy their bond. Yeah. You're going to borrow them the money. And there's all types of different risks that you can take on in a portfolio. Some are more volatile, which would be how we would maybe describe them as riskier or less risky. I tend to not agree with that philosophically, that volatility is risk. But anyways, I say all that to say that you're going to end up with some amount of volatility, right? Totally. Like risk will always carry some degree of volatility, right? And if not, you should be really scared because you're probably getting lied to. But when you have good planning in place, right? When okay, hey, if we stress test the portfolio and instead of a 10% return, we get a 0% return over 10 years, or hey, the stock market crashes 30% next year and then recovers over the following 5. Like, what does that do to my net worth? What does that do to my situation? And you say, but my long-term care is taken care of at the end, right? Yeah. Hey, I've got the pension or I've got Social Security to help cover some of my, income needs. And so as you start liability matching your retirement, you can adequately take risk that is easier to weather the risk and make sure that you are compensated for the risk instead of, buy and then, you freak out and bill, Yeah.
Well, one of the things that, I really like that term liability matching, a situation that popped up today that I don't think I've emphasized as much as I should in some of the long-term care planning, is the ability to plan from a tax perspective with long-term care. I haven't emphasized that because a lot of the cases that I've done, you can use qualified funds for some long-term care products, but a lot of them, generally it's non-qualified funds. Yeah. But I have a case this morning that I was working on with some clients who don't have a tremendous amount of assets, but it's really important to them that they had some recent friend situations where some people in their neighborhood had long-term care, and that kind of woke them up to where, like, man, I really need to solve for this issue. But one of the things that I think also needs to be addressed is this tax efficiency play. And this came up in the conversation with their financial advisor. Is this guy was kind of like, I don't know if I like this asset-based, long-term care stuff that you're talking about, because most of their funds were tied up in qualified funds. And I was like, well, what happens if they just self-fund? What's going to happen to their taxes there? That's going to totally blow up, their plans that they had for RMDs. They're not going to be able to predict, well, what, we're going to draw down X amount per year. It's just, it costs what it costs. And then the tax bill kind of adds insult to injury on top of that if it's coming out of qualified funds. Yeah. And so where I think that maybe there's some perspective shift with that advisor was by saying, hey, we can actually set up a plan and I could tell you, here's exactly what the income draw is going to need to be. Then you can plan for the tax implications of that by drawing an extra 10 grand a year or whatever for income. And he's like, oh, okay, I get that. Whereas otherwise, if they were self-insuring, it would have just been a blank check to the IRS of, I don't know how much I'm going to have to pay in any given year. What are your thoughts on that?
Yeah, I mean, that you're uncovering and going down a tax planning conversation where There's this theory, right, where so many planners will say, hey, if your tax, rate in your working years is the exact same in retirement, it doesn't matter if you do Roth or traditional. And my general point is like, okay, so then I would want to take the bet on okay, I'd like to take the bet then where somebody can't raise my taxes.
Yes, exactly. Legislation risk.
Yeah, right. Like, so I tend to skew really heavy towards Roth whenever possible. It's not perfect. It's incredibly nuanced, and there's definitely a difference of opinion. But what I have found is it becomes really challenging when people haven't filled up like a Roth bucket.
Yeah.
And so they get to retirement, and I deal with this quite a bit. And a lot of times it's not because people were negligent or bad investors, but it's because they typically had a 401k plan. The 401k plan until a couple of years ago typically didn't have any kind of Roth offerings. Yeah. It was, so their only outlet was to tax defer. And so it's not uncommon somebody now goes to retire and like they might have like,
that's where most of their money
$1 million plus in an IRA or 401k. But they still have like 150,000 on the house. Right. And it's a challenge because, as you start doing your distribution planning and you start doing your tax planning, it's like, man, you're going to, like, you have to pull, like, you either have to pull out more money every month to make the mortgage payment. If you want to eliminate the mortgage payment and not pay the interest, right? So like you got to play this interest rate arbitrage game. And well, then you're like, well, I got to pull out not 150,000 to pay the mortgage off. I got to gross that up for taxes, but because I already still have to pull out money to live my life, you know what I mean? Now I was already planning on pulling out, say like 50 grand or 75 grand. Well, now I'm pushing it to 200, 225. Well, now I got to gross it up based on the marginal tax bracket at 225. So now I got to gross it up, let's say with, all in with state taxes, whatever it's called, 25%. Well, like now you're pulling out nearly 200,000 to pay your home off. That's 150,000. So you take $150,000 bath. Well, all of a sudden you're like, you're like going like, well, I'm retiring with $1 million, like to like, at the end of year one, I'm going to have 700,000. Yeah. You're like, what happened?
Yeah.
And whereas at least if you had the Roth bucket and it was so important to pay off the house, right? You could say, okay, I can chunk it. I can just completely wipe that out, right? Like I can take that big liability off the balance sheet. Now, a lot of planners might not even agree with my use of Roth there, but I'm just saying like, you have the flexibility all of a sudden. And that concept, I think most planners would all agree with, right? Is having tax flexibility is a huge benefit to planning over time. I think the other component people don't think about is actually that, it's always this argument of Roth versus traditional. And they forget about that taxable bucket in the middle where it's just a brokerage account because it's not the sexy thing, right?
Yeah,
like
exactly.
You open a Charles Schwab account, you buy some index funds or, buy some bonds. It's like,
money
there's
market,
there's no contribution limits, but you take it out anytime. It's like it's the ultimate like flexibility. And depending on how you manage it, you can still get a lot of the tax efficiency you're looking for out of either of the other type of accounts. You can get none, but you can get all the liquidity you could possibly hope for. Right. And it's like, you just got to have that diversification. And I the older I get, the more I love diversification, right? The more seasoned I get, diversification, I feel like I don't really talk to people that say like, gee, I just wish I would have been less diversified. You know what I mean? Like, usually the people that make that joke are somebody that's like, they bought a bunch of Bitcoin at Moonshot and they said like, I wish I was less diverse. I wish I would put it all in Bitcoin. But they're usually like half joking because they're happy. They still just got a great return. I think it's a mindset thing where people just like, it's so hard in finance. Mitch, it is so hard to not have FOMO in finance. It absolutely destroys finances to have FOMO, right? And I think one of the greatest disservices that have happened to the retail investors is the concept of benchmarking, truthfully. And so this idea that you're going to turn on the TV and they're going to say the S&P 500 is up so much this year, blah, blah, blah. And everyone, so the implication is kind of like, so your account should be up. that much. And if you're going like, man, I can't believe it did that. And what we all do naturally is go, man, I should have never put that 100,000 in a long-term care contract. I could have put that 100,000, market's up 20%. It could have been 120 all of a sudden. Man, if this goes on for just 4, 5, 6 more, 7 more years, I could have just had way more money than I'll ever get out of benefit, even if I need it, you know?
Mm-hmm.
And the reality is that's just not how markets work.
Yeah.
And so right now we're in this period where we're coming off of like greatest bull market run like in history. And we're all going, hey, S&P 15% a year.
Mm-hmm.
You know what I mean? And reality is it's really unlikely to do that.
Yeah.
And to demonstrate how disconnected that is from reality of the reality of economics is if you look at just even the equal weight S&P 500 right here,
mm-hmm.
and you look at the last couple of years, the return on that is very meager
mm-hmm.
by comparison, but it's in line with what you would expect stocks in aggregate to have done.
Yeah.
You know?
Mm-hmm.
And so a lot of people have missed the market structure dynamics that have driven
mm-hmm.
these indexes higher. And then media has put it in your face and told you have to buy that.
Yeah.
Or you're going to, be left behind. And if they're not doing that, then they're touting, the other hottest things, right?
Mm-hmm.
Whether it be, high flying tech stocks or Bitcoin or
mm-hmm.
whatever, right? And all those things have their place, right? Like I'm not at my core opposed to any of those things in general, but it's so tough to look at your neighbor getting rich, so to speak, right?
Sure.
And be like, no, I'm just happy to be diversified.
Mm-hmm.
I think like 7% a year is, what that's a good healthy return. If net of all my expenses, I'm making 7%, and I just do that for 20, 30 years. I should retire on time, retire comfortably, not have heartache along the way too bad. You know what I mean? But
yeah, it's sometimes just the unsexy thing.
That's the 4x4 with freaking snow tires though, man.
Exactly. The unsexy thing ends up being the sexy thing in the long run, right? And so, yeah.
But you have to go through the discomfort, right? So in order to be comfortable, you have to be discomfortable. And that's mm-hmm. the irony. And it sounds so stupid to say out loud, but it's like you have to be so uncomfortable being like, what am I doing making this modest return?
Mm-hmm.
Well, everyone else is just getting rich around me. I got to change what I'm doing. I got to change what I'm doing. I got to change what I'm doing. And the reality is like, no, if you're doing the right things and you're
mm-hmm.
building your financial plan well, and you're being thoughtful in all the things that you're doing, you're probably doing the right things.
Mm-hmm.
And other people right now might be getting really lucky around you. And we wish those people all the success and we hope it works out so well for them. But you got to play your own game in finances still. In finance, you still have to, it's called personal finance for a reason.
Yeah.
It's personal.
Well, I like, where you're going with that, because I think one of the biggest things that is maybe an issue when it comes to finance is when people don't have their money aligned with their values. Right? Like when there's this disconnect between, they're like, well, Ryan Kramer on Mad Money or whatever said that I should buy this stock, so I'm going to buy this stock. But that's where the value of an advisor, not, some financial, talking head, financial pundit who's giving this, just broad stroke sweeping advice. An advisor like you can help someone really line their money up with their values to say, hey, this is what I want to do for me. This is what is valuable to me. And it's tough to put a price tag on that is when you get that quality personalized advice,
Yeah. It all makes a difference and it all matters. And I think good planning is always going to help you understand the question of why, And, I think for me, one of the challenges I always face is when clients don't want to know why, they just want to give the trust.
Yeah.
And it's, very flattering
mm-hmm.
and it's a great honor.
Mm-hmm.
I really, really love when clients say, help me understand why we do this thing this way. Right.
Yeah.
And the reason why is because it gives that opportunity to display why, like, hey, I've designed this for you, or I'm managing
mm-hmm.
a portfolio in such a way or whatever. We're aligning it with a value. And so now you don't have to be concerned about this thing. Like, hey, it doesn't matter what, the TV or some other person or your kids, we have seen it across the board.
Mm-hmm.
We've seen people bring money over that was like all in, crazy stocks that their kids told them about. And they just bring them over going like, man, my kid told me about this. I totally got on board. Yeah. Man, it was like, it's been horrible and I'm so concerned, but I don't know what to do now. Mm-hmm. And the reality is like, the baseline is to go back to visit the financial plan. Is like, what do you need any of your funds to do for you? Yeah. Right. And what risks do you find acceptable taking? Mm-hmm. What does success mean to you? Mm-hmm. What outcomes around that are you okay with or not okay with? Right. And, in trying to solve for the ones that you find are not okay, what inputs are you willing to change?
Yeah, for sure. And I think when it comes back to the long-term care conversation with some folks, I've had a few conversations recently where some people said, hey, I don't want to take on any of this risk. I want a plan that's going to cover 100% of the likely risk, right? Mm-hmm. But then there's been other clients that are like, yeah, let's get a plan that's going to cover 60% of it, right? And then I'll, self-insure anything over and above 60%. Yeah. And so I think that a thoughtful plan, helps accommodate for that of whatever someone's tolerance is and what they value their money for.
I'm going to cue you in on a secret on this, right? Sure. This is like the portfolio manager in me. I had a hard time with this question when I first really started coming in the industry and managing money and stuff, because when you're just doing yourself, when you're managing your own portfolio, you just got to log on to Robinhood or Charles Schwab or wherever, right? And just say, oh, S&P's down a little bit today. I just got some money in the checking. I'll just move it over and just buy a couple more shares. Mm-hmm. You don't really think about it, right? Like no one downloads their spreadsheet of their holdings and says, what's my weightings on all this? And how many shares I need to buy and sell and everything to recalibrate my portfolio. And in light of that, I can seize this opportunity to sell some of my bonds and buy some of my stocks and take it back perfectly to target. When you're managing your own money, you don't even think like that. Like that's just not how people think. So as you start building portfolios and you start looking at multi-strat, different strategies, ideas, asset classes, all this stuff, there's this big question of like, how much do you put it in the portfolio for? Right. And the answer is that no one ever talks about is there is no reason to size it. Like there's no one good reason, right? Like, and you'll even hear people say, hey, position sizing is more important than what you buy, right? Like, hey, it's like, hey, there's all this stuff and there's all these quips, but in reality, like you can say, hey, I do, risk parity where I adjust all the holdings relative to the volatility they contribute to the portfolio. Mm-hmm. That's one way to do it. Mm-hmm. But like, why 60% funded for long-term care versus 40% funded for long-term care? It's because you like the math that way. Yeah. Like that's literally it. I wish I had more for people that were like the secret equation, but it's like, man, like, listen, if you're, I used to think about it like this with people, like when, this was before like gold and silver were like really hot, and so if you think back to like 21 or 2022 even, right? Like it was going through a tough period, but people would call and I'd have these conversations with people every once in a while and they say like, how much gold should I have? How much silver should I have? And it's like, well, what do you want it for? Mm-hmm. And well, I'm worried the dollar's going to collapse. I'm worried the government's going to collapse. I'm worried financial markets are going to collapse. It's like, should I buy gold and silver? And I'm like, look, if that's what you perceive to be your hedge or your insurance against that, listen, if you're super convicted, you just go out, you put everything in it, right? Like that's one way to do it. Okay. So position size is max, mm-hmm. It's like, in fact, you know what, if you think the financial system is going to collapse, like, I don't know, mortgage everything you have to buy more gold. I don't know. Okay. Well, that seems ridiculous. Okay. Well, so then how do we bring it back to this conversation? Because I can't look at it and say like, well, gold's twice as volatile as bonds or stocks or something. So you don't want 3%, you want 5%. It's like, no, there's no perfect math way to do this. Mm-hmm. You can look at it from a total portfolio and say, how much money am I willing to lose on this trade at a moment in time, right? And like, mm-hmm. you can adjust that way. That's kind of one of my preferred methods when I'm managing portfolios. Mm-hmm. But in reality, when you're sizing up like long-term care, you can't do that, right? Yeah. So I just think like what I'd come up with in these conversations is I'd say like, all right, let's be realistic here. Mm-hmm. Give me your probability of how much you think like what's a probability that you think the financial system is going to totally collapse, mm-hmm. And you're going to really need this gold or silver. They say like, well, maybe like 5%. Yeah. Okay. Buy 5% gold then. It sounds good. It's like, look, I wish it was more thoughtful than that. It's like,
well, I think it comes back to the aligning money and values, right?
You got to do what makes you sleep at night sometimes, mm-hmm. And so, hey, do you fully self-insure or do you fully insure? Right.
Yeah, totally.
Somewhere in between. Totally cool. But is it 30% or is it 70%?
Yeah.
You might look at it and just say, man, I get you're saying 7 out of 10, but I think I'm pretty healthy. I think I'm really only a 50-50. So maybe I'll like self-insure half.
Yeah.
Like just, hey,
and I think that's,
you got to do what you think you can handle. Right.
Yeah. And I think that's the beauty of working on a personalized plan is so that you can get into that nuance, you can get into the details and work with someone there. Because I think that I used to be of the mindset of, well, what's a financial advisor going to be able to do that I can't do with a robo advisor? And it's like, the answer is a lot. The financial advisor can bring insight to the table that you're just not going to get trying to self-manage or
and sometimes that insight is not in, how much long-term care do I need, but how comfortable I am with it of the impacts on the financial plan.
Totally.
Right. Like, so how much am I willing to commit from that angle? And I think that's the insight, right? So the conversation should be robust, but anyone that says, oh, well, my plan for people is to do half insured on long-term care or insure the whole thing or insure none of it, they're all full of crap. If they have like some pre-built plan in a book for you that says this is what all our clients do. Well, all of their clients likely have something that's not perfect for them, right? You know what I mean? It might be palatable, it might be prudent, it might be reasonable or understandable, right? But is it really right for you? And that's the difference between a boutique setting and somebody that's running a big sales funnel with their 10-step guide to read my ebook and
hey, don't hate on my ebook, man. Don't hate on my ebook. No.
I think in the wealth space, there's like,
you're totally right.
Bit different, but in the insurance space, maybe there is more of that. And I just, don't pay enough attention.
Yeah.
But, I think like, regardless of where you're at, right? Like no estate plan's the same, no 100%. Insurance plan's the same. And if you have the resources to say, look, like I probably can afford somebody's time to help me be thoughtful about this, you can probably improve. You can probably improve the plan with that, right? Not everyone has those resources, and gosh, we try to put out a lot of education to still help as many people as possible. But I think more people have the resources than they think. Yeah, to have that help.
Yeah. Well, I think that, what you're doing with this podcast and these sort of, these conversations, whether it was, the podcast that you did recently on, with Intermountain Health and some of those things, I think that there's just so much valuable information that you're putting out there that I really appreciate the wealth of knowledge that you are and kind of bringing that expertise in a way that's accessible to people, because, as much as you would probably like to sit down and meet with every single person, it's, this platform provides an opportunity for you to reach more people. And I think that's awesome.
I appreciate that. And as a way of just staying compliant in conversation always, I just want to highlight from a compliance disclosure perspective, I'm not an expert. I'm a professional. And I bring a level of professionalism to the conversation, but I appreciate the vote of confidence, Mitch.
Yeah.
I do. And thank you for the kind words. We just like helping people and trying to deliver some education. So, I appreciate you taking your time to come on and share some thoughts around long-term care. Where do people find you if they have more questions? Obviously anyone can reach out to me and I can always connect you, but if somebody hates the sound of my voice and wants to bypass that channel, where do they find you, Mitch?
Yeah. You can find me, on social media. My handles are, like just my name, Mitchell Hancock. Or you can go to valiantbrokerage.com. That's the homepage. And I've got valiantbrokerage.com/LTC for long-term care. If you're looking for an educational resource, that there's, a guide that people can pick up there at valiantbrokerage.com/LTC.
Cool. All right. I appreciate it. And, thanks everyone for sticking with us through this conversation. I know it's not the sexy thing, but if you understand capital efficiency, I think it is sexy.
Right.
But, I marched to the beat of my own drum there. Thanks for sticking with us. Hey, if you haven't, please hit us with a subscribe, give us that like, We very much appreciate it. It helps the algorithm. And as always, if you have questions, comments, concerns, jokes, hate mail, whatever it might be, you can find us at ducharmewealth.com, hit contact us, leave comments in, wherever you're watching the podcast, leave a comment, find us on Facebook, Instagram, leave comments there. You can go find me on X if you want and smack talk me there.
You're a brave soul be on X. Yeah.
X is the one place where I post all my own thoughts representing myself as my own name. Most of this, the Taluk stuff is kind of representative of, a larger group of individuals. And so sometimes it's a little bit more
unfiltered.
Yeah. On X for those that, like to hear me getting, theoretical conversations on different assets or whatever.
Nice.
Anyways, thanks for sticking with us, everyone. We will see y'all out there.